Something is wrong with this picture. Silver is sitting at $82. A war is actively running in the Middle East. The Strait of Hormuz is being threatened. Physical silver is being pulled out of vaults at a pace this market has never seen before. And the price is going down. And let that sink in for a second, because that is not how any of this is supposed to work. And if you think that is confusing, wait until I show you what is actually happening underneath the surface. Because the real story here is not the price you see on the screen. The real story is what is leaving the vaults while the price goes sideways. The real story is what one Wall Street firm just built without anyone noticing. The real story is what drops at 8:30 a.m. tomorrow morning that has the power to completely change the direction of silver in the next 48 hours. Stay with me, because by the end of this video, you are going to understand the silver market at a level that almost nobody watching financial news right now can touch. And that understanding is going to matter a lot before this week is over. Let me start with the vault numbers, because this is the data that should be making headlines everywhere right now. And it is barely being talked about. COMEX registered silver, that is the metal actually available for delivery, just fell below 87 million ounces. Now that sounds like a big number, but here is what it means in context. In 2020, COMEX held 346 million ounces of registered silver, 346 million. That was the baseline. Today, it is below 87 million. That is a 75% collapse in 5 years. 3/4 of the deliverable silver in the world's most important futures exchange has left the building, and it is still leaving fast. The COMEX drain right now is running at roughly 785,000 ounces every single trading day. Not every month, every single trading day. That is the rate of metal walking out the door while you're watching the paper price sit at $82. Let me put that in terms anyone can understand. If you had a bank account with $87,000 in it and you were spending $785 a day, how long before it hits zero? About 110 days, a little over 3 months. That is the math of what is happening to deliverable silver on COMEX right now at current drain rates. And that is before the war premium, before industrial buyers panic stock, before the March delivery cycle fully settles. But COMEX is only part of the story, because the drain is not just happening in New York. It is happening simultaneously on the other side of the world. The Shanghai Futures Exchange lost 710,000 ounces in a single session recently, in one day. Shanghai total silver inventory is sitting at approximately 8.7 million ounces, an amount that industrial China, the biggest consumer of silver on the planet, can eat through faster than you think. The Shanghai Gold Exchange, 436 tons of physical silver withdrawn in just the first 2 months of this year. The 8-year seasonal average for that same window is 62 tons. Think about that number. The historical average is 62 tons. The actual number right now is 436 tons. That is 7 times the historical average. 7 times. That is not elevated demand. That is a scramble. That is buyers across China's industrial base, solar manufacturers, EV component producers, semiconductor fabricators, pulling silver out of the system at a rate that has no precedent in the data. COMEX draining in the west, Shanghai draining in the east, both at the same time, both at historic rates. And the paper price is at $82. This is the divergence you need to understand before anything else. Because the question is not whether these vault drains are real. They are reported by the exchanges themselves. The question is, how long can the paper price ignore physical reality before the two things violently collide? Now let me take you to something that has been quietly building while everyone was watching the war headlines. One firm, one position, $5 billion. And nobody on mainstream financial television is talking about it properly. Jane Street. If you do not know that name, learn it now. Jane Street is one of the most powerful quantitative trading firms on Wall Street. A $662 billion portfolio. They are not a hedge fund making bets. They are a market-making machine. They profit from volatility itself, not from direction. Here's what they just did in silver. And I want you to pay very close attention to the sequence. In Q3 of 2025, just a few months ago, Jane Street held approximately 41,000 shares of SLV. SLV is the iShares Silver Trust, the world's largest silver ETF, backed by physical silver, custodied by JPMorgan. By December 31st, 2025, disclosed in their February 2026 SEC filing, Jane Street held 20.7 million shares of SLV. Not 20.7 thousand, 20.7 million. That is a 500-fold increase in 1 quarter, 1 filing, same firm. 41,000 shares to 20.7 million shares. A position now worth approximately $1.6 billion in equity. But the equity stake is not what should concern you. The options book sitting on top of it, that is where the real story lives. Jane Street simultaneously holds call options on 39.5 million underlying SLV shares. Value, $2.5 billion. Put options on 43.3 million underlying SLV shares. Value, $2.8 billion. The options book alone is over $5 billion. That is 3 times the size of the equity stake. Now, more than 87% of Jane Street's entire $662 billion portfolio sits in options. Not stocks, not bonds, options. This is a firm that is architecturally designed to profit from volatility. Not from silver going up, not from silver going down, from silver moving, from implied volatility expanding, from other market participants getting whipsawed in both directions while Jane Street collects on the chaos. And here is where it gets darker. Look at what happened in the silver market through late 2025 as this position was being built. Silver was climbing from the 70s toward $100 and beyond. The normal pattern when an asset rises sharply is for short interest to fall. Why would you pay to borrow shares to bet against something that is going up? But that is not what happened. Short interest in SLV rose through late 2025, even as the price was climbing. Rising price, rising short interest, both at the same time. And the borrowing cost to short SLV shares? It crashed. Normally when short interest spikes, borrow costs go up. Supply gets scarce. It gets expensive to borrow shares to bet against something. But in SLV through this period, borrow costs stayed abnormally low. Shares available to borrow were at multiples of what was available during the October 2025 squeeze. And implied volatility, the options market's measure of expected price swings, doubled from the October 2025 highs, even while price was rising. Rising price should compress fear. Rising price and exploding implied volatility happening simultaneously is not a normal market. Someone was building massive options. Exposure into the move, profiting from volatility itself, not direction. And the custodian of the physical silver inside SLV, the actual bars sitting in the vault backing all those ETF shares, is JPMorgan. The same JPMorgan that paid $920 million in 2020 to settle 8 years of federal charges for spoofing precious metals markets. That is not a theory. That is a settled federal case. Public record. Now I am not here to tell you Jane Street is definitely manipulating silver. No regulator has opened a formal investigation. Jane Street has denied any wrongdoing. What I am telling you is the structure. And the structure is this: the largest holder of the world's biggest silver ETF, with a 500-fold position increase in 1 quarter, sitting on a $5 billion options book specifically designed to profit from volatility, while simultaneously facing separate manipulation accusations in equities, in cryptocurrency, and in derivatives markets on 3 different continents. That structure exists. The data shows it. What you do with that information is your decision. But here's the critical thing you need to understand about paper silver and physical silver right now, because this is where the rubber meets the road. Physical silver is leaving vaults at historically unprecedented rates. COMEX drain running 785,000 ounces per trading day. Shanghai pulling 7 times the historical average. The March 2026 COMEX delivery cycle has already issued notices for over 52 million ounces of delivery demand. That represents more than 60% of total registered inventory. 60% of the available supply committed to delivery in a single contract cycle. If this were a normal market, that number would have already sent silver screaming past $100. But the paper price is sitting at $82. There is a gap between what the physical market is saying and what the paper price is saying. Gaps like that always close. The only question is which direction they close in, and the data on the physical side says the answer is not down. Now let me talk about the March COMEX delivery cycle specifically, because this is happening right now, not weeks away. Right now. A 159 million ounce sell order hit the silver market recently and triggered a trading halt. Let that register. The exchange had to halt trading because the order size was so large it threatened to break the market. That is not normal. That has never been normal. And the exchange has responded the way it always responds when the physical reality starts threatening the paper system. They raised margins, they introduced cash-settled alternatives, they changed the rules. This is the exact playbook from January 30th, when Kevin Warsh's Fed nomination sent silver crashing 31% in a single session. Same response. Raise margins, change rules, make it more expensive for small players to hold on. The people who cannot survive a 16% session get flushed out. The institutions with deep pockets and physical metal in private vaults wait. They have done this before. They know how it ends. Here is how Eric Sprott put it. The billionaire investor who has been right about silver for 20 years. He used the phrase revaluation shock. He said if the physical supply drain continues at current rates, silver could experience a revaluation that makes $150 look conservative. That is not my prediction. I am not telling you what silver will do. I am telling you what the physical market math produces when you run it out 90 to 120 days at current drain rates. And the math produces numbers that are a long way from $82. Now, let me give you the thing that could change everything in the next 24 hours. NFP, non-farm payrolls. The February jobs report drops tomorrow morning at 8:30 a.m. Eastern. For those who are new to this, non-farm payrolls is the most important monthly economic data release in the United States. It tells the market how many jobs were added or lost, and it directly controls the US dollar index. And the US dollar index directly controls the price of silver. Here is the current situation going into this report. January 2026, NFP came in at 130,000 jobs. That smashed the consensus forecast of 70,000, nearly double what was expected. The dollar caught a bid, silver fell. That is the mechanical relationship. For February, tomorrow's report, the consensus forecast is 50,000 to 65,000 jobs. Bank of America forecast 35,000. Wells Fargo is even lower. Some economists estimate as few as 25,000. The range of predictions is enormous. And when the range of predictions is enormous, the range of possible market reactions is equally enormous. There is also a wild card in this report. A major strike at Kaiser Permanente during the February survey week artificially depressed job counts for a specific period. Bank of America flagged this directly, so even a weak headline number needs to be interpreted carefully. It may not reflect the true underlying trend. Here is the binary that determines silver's next move. Scenario 1. The number comes in weak, 35,000 or below even the already weak consensus. The dollar sells off. The DXY drops from its current levels toward 96 or lower. That removes the single biggest mechanical headwind from silver. Remember, the entire reason silver is at $82 instead of somewhere higher is dollar strength. Every full point the DXY drops puts $2 to $3 back onto silver mechanically, without a single supply or demand condition changing. In a weak NFP scenario, the structural physical story, the vault drain, the Shanghai premium, the delivery crisis, the Jane Street structure, the war, all of that gets to speak again without the dollar pressure muffling it. That is the scenario where silver tests $88 to $92 within days. Scenario 2, the number beats. 130,000 again or close to it. The dollar surges. The DXY holds above 98. The 10-year Treasury yield climbs back toward 4.1%. Silver gets hit with the same mechanical pressure that has been holding it at $82 all week. Paper price could retest $78 to $75. But here is what I need you to understand about scenario 2 before you panic. A strong jobs number does not change a single ounce of the physical drain, not one. COMEX does not refill because the labor market is resilient. Shanghai does not stop pulling silver because unemployment held at 4.3%. Industrial manufacturers do not cancel their procurement because wages came in at 0.3% month over month. The physical reality of this market exists independent of what the Labor Department prints tomorrow morning. What the jobs number changes is the dollar. What the dollar changes is the paper price. What the paper price does not change what is happening in the vaults. If you are watching the paper price fall on a strong NFP and thinking the silver story is broken, you are confusing the price with the metal. They are not the same thing right now. The vaults are proof of that. Now let me give you 4 specific things to watch tomorrow and through the weekend. 4 signals that will tell you which scenario is materializing before the mainstream media figures it out. Signal 1, the NFP headline number at 8:30 a.m. Not just the headline, the unemployment rate and average hourly earnings. If unemployment stays at 4.3% and wages come in soft at 0.3% month over month, even a moderate headline will be dovish for the dollar. That combination removes dollar pressure from silver simultaneously through 2 channels. Signal 2, the DXY reaction in the first 30 minutes after the print. Forget the headline, watch the dollar. That is the direct transmission mechanism into silver. DXY below 97.50 after the print is the first real signal that dollar headwinds are fading. A drop from 98 to 96 is worth $4 to $6 on silver directly by pure mathematics. Signal 3, the 10-year Treasury yield, currently above 4%. Watch for it to break below 3.95% after the report. That threshold signals that recession risk is starting to compete with inflation risk in bond market pricing. When yields drop through that level, the opportunity cost of holding silver versus treasuries softens. Institutional models that rotated out of silver and into bonds start to reconsider. Signal 4, Monday's COMEX vault report. Because if the war premium and a weak jobs number simultaneously spike physical demand over the weekend, Monday's vault data could show an accelerated drain on top of everything already happening. physical drain accelerating on top of a weak dollar, is the specific combination that has historically preceded the biggest moves in silver. 4 signals. Watch them in sequence. They will tell you where this goes before any analyst on television figures it out. Now let me tell you something directly, because I think this part matters more than anything else I have said. A lot of people watching silver right now are scared. I understand that. If you bought somewhere near $100 and you're sitting at $82, that is not comfortable. Watching a position go against you while a war is happening and vaults are draining and everything your thesis said should be bullish is happening, that psychological pressure is real. But here's what the data says about that fear. Silver was in the low 30s 12 months ago. Even at $82 after everything, after the war shock in January that crashed it to $63, after 2 separate violent corrections, after the war, after the vault panic, silver is still up more than 150% over the past year, 150% in 12 months. The people screaming that it is over every time silver has a violent session have been wrong every single time. They were wrong when it crashed from $121 to $63 in January. They were wrong when it recovered to $96 before the war. Premium added another leg. They are going to be wrong again. Not because silver cannot correct. It can. It does. It is volatile by design. The leverage math of a small market means violent sessions in both directions are part of the deal. You do not get 150% in a year without accepting 20% drops that feel like the end. You get 150% because you understand what the vaults are doing. You understand what the physical market is saying. You understand that the paper price and the physical reality are telling 2 different stories right now, and that these 2 stories always converge. And they never converge by the physical reality surrendering to the paper price. The physical market is pulling 436 tons out of Shanghai in 2 months. The physical market is pulling 785,000 ounces out of COMEX every trading day. The physical market had 10,526 delivery notices issued in a single COMEX cycle, representing 60% of registered inventory. The physical market is producing a $12 Shanghai premium to Western spot. The physical market has lease rates running at levels not seen since the 2020 COVID supply shock. And the paper price is at $82. Something has to give, and it is not the vaults. Now let me give you the honest bear case, because I am not going to pretend there is no downside here. If tomorrow's NFP beats hard, 130,000 again or above, the dollar surges. Silver takes another leg down. The $78 to $75 zone gets tested. Bank of America has an official 2026 average forecast of $81 per ounce, which implies prices in the back half of the year significantly below current levels. They built that model before the China export restriction, before the 98% delivery rate, before the 6th consecutive annual deficit was confirmed, but the institution is real and the number exists. If the war produces a diplomatic resolution faster than anyone expects, the geopolitical premium unwinds. Silver loses its safe haven bid. The structural story is intact, but without the war catalyst, the near-term price action goes sideways at best. If Jane Street begins unwinding any part of their $5 billion options position in a way that creates forced selling in the ETF, the paper price pressure can extend. The physical market will not care. But paper price pain extends before the physical reality forces repricing. These are honest risks. Size your positions accordingly. Do not bet more than you can hold through another violent session, because violent sessions are this market's normal. They are the price of admission for the gains. But here is the thing about the bear case. Every single bear scenario for silver in 2026 requires the physical drain to stop. It requires COMEX to refill. It requires Shanghai to stop pulling. It requires the 6th consecutive annual deficit to somehow reverse. It requires the 60% delivery demand relative to registered inventory to somehow resolve without a price spike. None of those things happen because a jobs number beats estimates. None of those things happen because a currency index moves 2 points. None of those things happen because one firm reorganizes its options book. The bear scenarios exist at the paper price level. The structural story exists at the physical level. And right now in this market, at this moment in history, the physical level is more real than it has been in decades. This is what the 1980 silver run looked like in the early stages, not in terms of price, in terms of structure. Physical tightness, paper price lagging, vaults draining, institutional positioning building in the shadows, and then one catalyst, one moment where the paper price and the physical reality stopped being able to coexist at the same price level. In 1980, that catalyst was the Hunt brothers running out of room to carry their position. Today, the catalyst could be a single 8:30 a.m. data point tomorrow morning. It could be a Monday vault report that shows the drain accelerating. It could be a tanker getting hit in the Strait of Hormuz. It could be any one of 4 or 5 things that are all simultaneously loaded and waiting. The market is sitting on a compression spring. NFP tomorrow is the first test of whether that spring releases or tightens further. Watch the 8:30 print, watch the dollar, watch the yield, watch the Monday Vault report. If you are new to this channel, the reason we cover silver differently than anyone else is because we go to the actual data. The Vault reports, the delivery rates, the exchange filings, the institutional positioning, not the headline, not the sentiment, the data. The data right now says one thing. The physical market and the paper market are telling completely different stories. And in every market, in every commodity, in every asset class where this divergence has appeared in modern history, it has resolved in the direction of the physical. That is not a prediction. That is a pattern. And this pattern has now been running for months with more structural confirmation behind it than any point in the last 5 years. Tomorrow, the next chapter starts. Be ready for volatility in both directions. Know your levels, know your signals, and do not confuse the paper price with the metal, because right now, they are not the same thing. If you want real analysis on this in real time, not after the move happens, not when the headlines catch up, subscribe. Because the next move in silver is not going to come with a warning. And by the time the mainstream covers it, you will have already needed to know. Stay sharp, stay positioned.